So thanks for that, Austin. Hello, everyone, and welcome to the latest edition of the Tranquilli Financial Advisor and Horizon Investments conversation. I'll call it series because we have had a series of these. As you know, each time we start these conversations, I am required to read our disclosure. I'm glad to do so because it is part of compliance. It's what allows us to have these conversations and share our thoughts and opinions with you. And hopefully you'll take this video conference, which will be posted on the YouTube channel, which is Louis Tranquilli. You'll take that and you'll share it with friends in the future. But let me get to the read here. This webinar was created in January 2021 and is provided by Horizon Investments, LLC and Tranquilli Financial Advisor for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee, that is in bold letters, against loss or declines in value of your portfolio. It is an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when Risk Assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have Risk Assist feature. While Risk Assist was designed with goals of limiting drawdown, Horizon is not able to predict all market conditions and ensure that Risk Assist will always limit drawdown as designed. Accounts with Risk Assist are not fully protected against all loss. That is Horizon Investments. The H in Horizon, gain, protect, spend, Risk Assist, real spend are registered trademarks of Horizon Investments, LLC. All right, with that out of the way, I appreciate and respect compliance. So glad to have that out of the way. I'll introduce our guests again. We have Austin Fitch. Austin is a CFA, which is the highest designation one can achieve in the financial field. He is an analyst, a senior analyst at Horizon Investments, has been with the firm since 2014. Austin is responsible for conversations that like this with financial advisors, like Tranquilli Financial Advisor. He and I have had the pleasure of getting to know each other very well over the course of the last year and a half, 2 years really, 2 full years since I've become an RIA. He's been integral in part in the conversations that I'm having with clients. So Austin, welcome again. And of course, Josh Bartholomew, who I've known now for coming up on 20 years, which is really rather remarkable. Josh is head of practice at Horizon Investments. Josh's work is to visit with other financial advisors throughout the country. I've mentioned that before during our webinars. I would like to expand on that just for a moment before I welcome both of them in fully and we start the conversation. Josh is responsible for, is partially responsible, I'll say, for me meeting other financial advisors throughout the country. You may wonder why that would be important. Well, Josh's work is to introduce financial advisors that are like-minded, have a good way of doing business to each other, and we share those ideas. We share the work that we're doing, and it only, I believe, makes Tranquilli Financial Advisor better at their work, and hopefully I'm doing the same for those out there. So with that, welcome Josh, welcome Austin, thanks again for some time, and please, Josh, I'll leave it to you right now to say hello again and bring us into this conversation.
Well, happy Friday. I'm glad it's Friday. It's been a whirlwind of a week even as a short week, it's a lot that's happened in the last week, really a lot that's happened in the last month. So I think, Lou, you hosting this call now is very timely. I know there's some things that we want to cover that are specific that we've prepped for, and so hopefully you all will find this very interesting. I'll just say what I always say in these calls is that Lou's right. I work with my team and I work with small group of advisors around the country, while Austin does a lot of the heavy lifting and a lot of the work that is reserved for really, really smart folks. What I do is try to find the best advisors I can in the country, and as Lou mentioned, bring them together to sort of look at what best practices are in terms of helping clients achieve goals and objectives. And so Lou's exactly right. That's what we do. So I spend a lot of my time doing. And there just aren't that many of them out there. So all of you that are on this call, I'm thrilled that you're with Lou, because he's one of the few that I think are really, really excellent at what they do, put a lot of effort into what they do, and holds the rest of us accountable for making sure that we execute the way he expects us to. And we do that most times, not in every case, but most times we do, and we try to work hard to communicate together to fill in the gaps when necessary. So Austin, thanks so much for joining us again today. And Lou, I know there's just a lot to cover, not only just in terms of ideas about the future markets over 2021, but also just what's happening here recently and those effects that they might have in the market in the short term. I mean, I do think there's this sense of people loving the fact that we went from 2020 to 2021. And while that did happen, there is just still a lot to sort of unpack, and things don't necessarily change overnight. Yeah, there's a ton, we think, to be positive about. You don't always see that in the news. There are definitely things that could be headwinds, but there's a lot to be positive about, I think, guys. So Lou, thanks again for having us. And I know Austin's got a lot to share with you. I'll let you kind of kick it off and just sort of where you want to start.
Yeah, and thanks, Josh. Let's just get this out of the way right away. Yes, I have a Billy Ray Cyrus hair going at this point during the pandemic. Okay, we just
you did this in March and you had a full beard, and everyone commented on the beard. Now it's the hair. I don't know, And
I had a suit on similar to what Josh is wearing, but with the hair, I just thought this is ridiculous. I'm amongst friends. We're just let me just put the Nike on and we're good. So anyway, Austin, let's get right to it. The important part. Obviously, the conversation of the week, a new administration in place. We do not have to go backwards as it applies to comparison, but let's talk about some of the news that's come out recently and how we're going to apply that to 2021 investing, the discussions that we'll continue to have. So new administration, a couple of questions came in. Interesting, I thought. $15 an hour, possibility of $15 an hour minimum wage. If you could spend some time talking about the impact that has. Positive, negative, whatever it may be. And then also, of course, the stimulus package. We were talking just before we got started about the possibility of that being delayed. What does that mean to everyone that's listening now and will listen later on?
Absolutely. And Lou, thanks again for having us on. I think as we've talked about, you and I and many of our calls, the political side of things, really, and it seems probably over the last 3, 4, 5 years, has become just like you would do fundamental analysis or quantitative analysis or economic analysis. It's almost as if you have to have a political analysis arm when it comes to your research. So I think it's extremely important. I think as you mentioned, we're also going to talk about it in the context of how it affects portfolios and the market. Obviously, we could have a completely separate conversation about the social side of things when it comes to politics, but that has probably little to no impact from a portfolio or from a market standpoint. So we'll keep that to maybe the after hours conversations. But with that being said, I would say what we've seen really to kick off the year, and we've gotten the question from folks, is what's the outlook, or how do we feel about the current political outlook, given the fact that you do have power concentrated within the Democratic Party? And I think it's probably everybody on this call knows, obviously the Democrats have control of the House of Representatives. They technically have control of the Senate. albeit it's a 50-50 split between Republicans and Democrats, but you do have that tiebreaker vote from Vice President Harris. And then obviously you've got President Biden in the White House now. So I think there were questions around kind of this idea of a blue wave scenario. And what I would say to that is, while yes, technically the Democrats do control kind of those three avenues, both the legislative and the executive branches, it's a very different scenario than maybe what markets were a little bit fearful of back in October, September, when it came to truly a blue wave scenario. And what I mean by that is, what the markets were fearful of was a scenario where you had a super majority in the House of Representatives, where you had a pretty significant majority in the Senate, and the presidency as well. What we saw in the November election, and even with the follow-up kind of runoff in Georgia that kind of tipped the scales in the Senate, is Republicans actually picked up seats in the House of Representatives. I would say the majority that they have is less than 10 seats, so it's marginal at best. Within the Senate, as I mentioned earlier, it is basically a 50-50 split in terms of Republicans and Democrats. And why that's important is because to get legislation passed, the marginal vote now comes from somebody, from a representative or a senator that probably inhabits or represents what we would call a purple district. And what I mean by that is that's a district that has historically kind of flipped back and forth between Republicans and Democrats, right? Joe Manchin in West Virginia is a great example. He's very much what we would call a conservative Democrat. And why that's important is because if he's the marginal vote in the Senate, for example, then what you're looking at is you're probably not going to get some of the more radical or progressive agenda items that maybe would have been on the table had you gotten that true blue wave scenario. So fast forward to where we sit today, I would tell you that we're not terribly concerned from a political standpoint in terms of the impact there. We don't think it's going to be terribly prohibitive. We do think the $15 an hour minimum wage conversation is relevant. We think that is a little bit of a headwind. Realistically, if you look at a number of different businesses, that's really only going to have an impact on a minority or a small segment there. The $15 an hour minimum wage, because in a lot of places you're already seeing those types of wages anyway, whether that's at the state level or even some of the local levels. And for that matter, even some corporations have instituted minimum wages in that $15 an hour range. So I think, again, I think headline-wise, it will absolutely grab a headline. It will be on CNBC. It'll be on your nightly news. But I don't know that impact-wise it will have a dramatic impact on daily operations from a business standpoint. You talked about stimulus. I think what I would say is obviously the possibility of a smaller stimulus on the margin is not ideal from a market perspective. But as I told Lou, if it's $1.8 trillion or $1.9 trillion, then it's really kind of not a big deal. And I kind of chuckle as I say that. And sorry, I say $1 billion, should be $1 trillion. But what you're looking at there is it's not really, it's kind of a drop in the bucket, unfortunately, from a budgetary perspective for the government. And from a market perspective, same thing. Now, what I would tell you probably is more impactful is the idea of it possibly getting delayed. If it's delayed a week or two, probably not a big deal. I think the market's fine with that. You may see a little bit of volatility in the interim. But what I would also say is that if you're looking at if you're looking at a delay of 6 months, for example, that's when markets probably really start to have an issue.
Okay, and that leads into the conversation that the markets, the current market conditions, looking at both the stock market and the bond market, which we are always focused on both of them. I don't, again, believe there's enough conversation around the bond market when even video conferences like this happen. When I'm talking with investment firms like Horizon, you're good about bringing up this is how the bond market impacts the stock market and how we should be looking at that impact. I would like your thoughts on that, and I'll say expansive thoughts, and I'll sit back and listen to it. Two things to touch on, if you would, during the conversation. A lot of talk about the national debt hitting $30 trillion. And also one thing not spoken about quite as frequently, at least during this pandemic time, the amount of savings that Americans are, I'll say, sitting on at this point. I would be interested in your thoughts as part of the conversation and how that impacts the market as well.
Absolutely, and maybe I'll take the savings piece first, and then we can transition to kind of that debt conversation, because there's a lot to unpack on that one as well. But from a savings standpoint, I would say this. So consumers in 2020, once the pandemic started, I guess let's call it March of last year, consumers saved over $1.5 trillion, which is obviously probably not a small number to think about. But why that's important, and maybe that's not surprising if you think about going through a recessionary period or a period with so much unknown like we were in, and for that matter, in many cases are still in regards to this global pandemic. It's probably not surprising that folks got a little bit more conservative. They kept money on the sidelines. Maybe they didn't put money to work in the market, or they didn't undertake big projects. So it's maybe not terribly surprising to see folks be a little bit more conservative as you go through a recessionary period like that. What is maybe surprising is if you actually look at the combination of those savings that are, again, money sitting on the sidelines. Think of it as dry powder. Think of it as money that at some point probably will get into the marketplace, whether it's through goods and services or actually into stock and bonds. But the combination of that savings with the personal income increases that we actually saw last year. And I say increases, so we looked at it, and we did a study where we took income levels and really kind of created a trend to see at what rate were they increasing prior to the pandemic. And then we forecast that forward to the end of 2020 to say, if we had had no pandemic at all, where would you have expected personal income levels to have been at the end of the year? What you saw was actual income levels were higher than what the trend would have otherwise expected. Now, to be fair, some of that obviously comes from income that was provided by the government last year, right? With the stimulus monies, that is absolutely a component, and I'm not underselling that, and we can talk about that separately. But at the end of the day, it is still income. It is still in the consumer's pockets. It was money given to businesses that they were able to pay employees. And what you see now is you see an environment where people actually are still making money. Actually, they're making more money than you otherwise would have expected them to make in aggregate. Again, we're not talking any specific segment of the marketplace, but in aggregate. And the fact that in aggregate, people have saved over $1.5 trillion. The combination of those two forces, as we start to come out of this pandemic, as the vaccines start to take hold, as you get that herd immunity, we think the combination of those two forces really serve as a tailwind as we get especially into the second half of 2021. And you're actually starting to see that from a business standpoint in terms of folks planning for a ramp up in production. They're planning for a pickup in consumerism as we get into the second half of this year. Again, I think we're looking at it internally here at Horizon to say that probably for a decent amount of the population to get vaccinated, realistically, it's going to take 6 months, right? So you're looking at June, July of this year when you start to get this return to some sense of normalcy. And I hesitate to say a return to normal, because I think it's also fair to say, later this year, we'll still probably be wearing masks. There still will be some form of limitations in regards to capacity. But you will probably now be able to go out to eat a lot more easily. You will be able to go to a shopping mall. You may be able to go to a sporting event or a concert That type of kind of reemergence of the consumer in a period where they have money that's sitting on the sidelines and they're not making less money than they were. They're not making any less money. Actually, they're making a little bit more money than they were making 12 to 18 months ago. By the time we get there, I think sets up really nicely from an economy perspective as we get into 2021.
Austin, I hope you're right, because I have Black Rose tickets at Red Rocks in Colorado for Labor Day, so I hope I can make that concert. But I think it's interesting. We've talked also about stimulus in past calls. I know you're going to get to national debt. But just if I can, in addition to higher wages, savings that might be deployed, we still have this sort of effect of stimulus that continues to happen. All of things that, while we might have thought the world was going to come to an end when the election went the way it did, and that didn't happen. The market charged forward in the fourth quarter, been pretty sanguine even this year so far. What's your thought about stimulus too? You add that to it and you've got a pretty good setup for 2021.
Yeah, no, 100%, Josh. I think, and to your point, we didn't even talk about the fact that you've seen stimulus monies enter the system, and for that matter, they're still entering the system. That, like, if you actually look at the numbers relative to 2008, for example, when it was really the only other time you saw global coordinated kind of stimulative activity. What I would tell you is the stimulus activity that you've seen globally, also within the U.S., but if we just look at it globally, dwarfs what we saw in 2008 as a percentage of GDP, which the first time I think that we looked at that internally was kind of mind-boggling, and it's not even close. I would tell you the stimulus measures that were taken in Europe relative to what was taken during the Great Financial Crisis, 10 times greater. In the U.S. right now, we're 3 times greater. And Lou, as you mentioned, there's more stimulus money coming. The amount of money that has been pushed into the system, or like I said, is being pushed into the system, is mind-boggling to some extent. Now, we could have a conversation, and maybe to the conversation of national debt. This will at some point be something that has to be dealt with. I think right now it's not, I won't say it's not relevant, but I will say it is not something that the market is concerned about. And we don't believe the market will be concerned about it this year. And for that matter, probably next year or even the year after. We think it's probably more of a 5 to 10 year problem in terms of thinking about how they unwind the balance sheet, how that debt conversation is dealt with. And maybe why that's relevant is for us to maintain that level of debt. You're probably going to see interest rates, and I say us, for countries around the world to maintain the amount of debt that is currently on central bank balance sheets. You're going to continue. It's going to be very difficult for rates to be any higher or much higher than they are today. Because in reality, the debt service associated with the levels of debt that are out there, that could be crippling if you were actually paying 3, 4, 5% on the debt that's out there. Again, where we sit today with interest rates as low as they've been in decades, and again, we've looked at it, and to say that rates are going to go significantly higher from a fixed income perspective, there's really just not a great way that happens unless everybody in the world decides that they're comfortable and they're willing to pay more to service their debt. And right now, there are countries out there that can't afford that, much less they have, obviously they have no desire to do that. And I'm specifically in that case talking about Europe and Japan. That's the other thing I would say, if you look around the globe from a debt perspective, is while we may look at it here in the U.S. and feel like debt relative to GDP or debt just in aggregate is very concerning, I will steal a saying that my good friend Mr. Bartholomew uses. We are the valedictorian of summer school, in that we're the best of what's out there. It still may not be great, but from a relative perspective, and if you think about at some point from a market perspective, you got to put money to work somewhere. U.S. equity markets, the U.S. economy is still about as attractive as any place out there. Again, longer term perspective.
All right. And I'll jump in there. Something we may have touched on in the past, because I do want to get to bond yields and specifically to bond yields next. But the servicing of the debt that we have on the books in the United States, we are capable of servicing it. It's different than a lot of countries that are look like they're capable. We are actually capable of servicing it. I do want your thought. Are we refinancing our debt as a country right now? Is that what all of this, could that be considered, that our rates are so low? And of course, if you're in Germany, you're getting, I believe it's zero. So if you give them money for 10 years, you get that money back. France,
actually, you get less than that back.
You do in Germany.
You're paying for them to
hold your money,
right?
and say, we'll give it back to you. Okay. France is the same way, if I recall correctly. So even if we're paying as in the U.S. On bonds for sovereign nations, we're paying 0.001. We are summer school valedictorians. So effectively, it's just the best deal that you can get, and it's a great deal for us as well. So 100%. Why not, if you will? Why? Yeah. This is one of those times where it's money is so inexpensive to acquire. Why wouldn't you acquire it, kind of thing? And that's how the government's being run. I've read. I'm a big believer, and this goes back to, I'll say, my upbringing. I come from a blue collar family, and something that I've always looked at as a financial advisor, curiously enough, are orders of automobiles or automobile sales, which were down better than 20% in 2020. So just imagine the number of vehicles that will be sold over the course of the next 2, 4, 5 years. It alone can drive the economy forward with all the jobs and just what that creates. But also I talk with a lot of I'll say the people that are on the ground, literally landscapers, contractors. I just know them. I grew up with them. I know them. I talk to them. They are booked. They are so busy, and they remain so busy. So there really are a lot of good things out there from the standpoint of activity. Like you said, money. There's money to be spent. All of those things will ultimately come back, push, I could believe, the market upward. But that leads to, by the way, I have to qualify, that's not a prediction that the market's going up. I mean that just, it pushes more money into the market's value of stocks, everything else. So with that clarification, bond yields, you've got to talk about them. Plenty of people looking at retirement thinking exactly the opposite of what I'm talking about right now, which is, well, what does that mean for me if I want to go out and buy the security of a U.S. debt? The 10-year bond is paying, is it even 1 at this point?
Yeah, it's been hovering right around 1. I think right now it's slightly above 1, but yeah.
So talk about the bond yields and how do we fit those into portfolios? What would be their place in portfolios in your opinion right now?
Yeah, no, I mean, I think that's absolutely a fair question, and something that we've been, I would say, doing a lot of research on probably over the last 6 months as you start to get to the realization that for financial advisors like yourself, Lou, retirement planning for clients in an environment where bonds are paying you next to nothing is going to look different. And that's, again, I think that's unique or that's, it's important to understand because for, let's call it 30 years now, if you're retiring, it's the classic, like, put your age in bonds in your portfolio, right? If you're 70 years old, you put 70% of your portfolio in bonds. And unfortunately, what you would be doing now, if you follow that kind of mantra, is really you would be putting 70% of your portfolio into something that isn't going to, make you anything, unfortunately. And that's, like I said, that's probably going to be the outlook for the foreseeable future, which means if you're thinking about retirement if you're thinking about generating income, we have to kind of turn the problem on its head a little bit. I'll say this. Bonds will continue to be a source of capital preservation. So similar to the example that you gave with Germany or France, if you want to be able to put your money somewhere and get your money back in 5 or 10 years, yes, you can absolutely still expect to do that in bonds, especially knowing that, if you're going to plan to hold it until maturity, from a bond perspective, it will continue to do that. But the problem is, I would say, that folks have grown accustomed to bond returns being somewhere between 4.5% and 5%. And again, it's been that way for 3 decades, so it's not unreasonable to have believed that kind of was the norm. I think probably even many people on this call may remember when bonds paid 8, 9, 10%, and you could put 100% of your portfolio in bonds. The challenge now is if you're only getting, let's call it 1% on your bond portfolio, what do you have to do with the remainder of your portfolio to generate the total return that you actually need to retire on, right? Or that you need from an income perspective. And what we've done the work on, again, internally, is to say, okay, very, very simplistically, you could put more money in equities, right? And that's, I would say, maybe the obvious answer. But what comes along with that is obviously more volatility. There is, and I would say will continue to be more volatility in stocks than bonds, generally speaking. So if you just took a portfolio where you had, let's say, 70% bonds and you made that a 50-50 portfolio, 50 bonds, 50% stocks, what would you expect there? Well, you may expect a higher return than you would otherwise get, but you should expect more volatility. So then the question becomes, well, is there a way to generate maybe some similar or some higher return perspective, but maybe not take as much risk? And I'm not here to tell you that there's some holy grail that that we found here at Horizon or that has been hidden for the past 30 years. But what I would tell you is there is a way, if you think about risk mitigation, and Lou, you mentioned Risk Assist, which is Horizon's version of risk mitigation. But what we found is you can actually use risk mitigation types of strategies, whether that's Horizon or whether that's other managers, in a way to basically think of as a proxy for a portion of a bond portfolio. So maybe you take a little bit more risk from an underlying stock portfolio. So normally you would have held 60% stocks. Maybe now you hold 70% stocks in your underlying portfolio. But if that 70% stock basket, for example, has risk mitigation on top of it, you're actually reducing the risk, right? You're lowering the volatility. And over a full market cycle, you're not significantly reducing the return objective or the return expectations. So I say all of that to say that really this partial replacement of part of your bonds that, again, unfortunately aren't paying you much of anything right now, with more of a risk mitigated allocation, may actually be the way that we have to do it or need to do it going forward to generate the needed income for those retirees. And again, I'm also not saying sell all bonds and don't hold any bonds in the portfolio. I think there's a mix there, but the ability to take a little bit more equity-like exposure underlying in that portfolio, but to do it in a risk mitigated fashion. Again, from a research perspective, we think that's probably the best opportunity as you go forward over the next handful of years, especially in an environment like we've talked about, where bond yields are next to nothing.
Well, and Josh, anything to add to that, or anything you'd like to add to that, or before I?
Well, I think that it's an interesting conversation without getting into all the specifics of what this firm does or another firm does. It is a really good conversation because I know, Lou, you work with several different managers, all that are really good at what they do and bring different kind of specialties to the mix. But this is the conversation that every planner should be having with their strategist, which is, how do I solve for the questions my clients are asking in the environment that we live in today. And the biggest one, by far, and this is Austin alluded to it, by far the biggest one is how do I spend 3, 4, 5% for the next 25 years in a world where I can't hold 80% bonds, which is what I would have done in a traditional framework. And so people that are thinking progressively, that are thinking really about highest probability of success in solving the needs clients have, are having this conversation. And I think Austin's softballing it a little bit here. Bonds aren't going to make us any money. They are going to provide safety. There is a place for them in the portfolio for safety, but they're not going to make us any money for the foreseeable future. And I just think that just because things were a certain way for 3 decades doesn't mean they'll be that way for the next 3 or the next decade. And we're in a window of time where they're compressed. Their time frame is compressed. So these are good questions to be trying to solve for, Lou. And I know we're doing that as creatively as we possibly can, but in a framework that makes people comfortable. I know your other managers are doing similar type of work, but it's very, very important right now in this environment to be having that conversation, especially if you're spending money out of a portfolio.
Well, and it gives me an opportunity, and for those listening right now and to listen to the replay, this is not part of what we prepared, but Austin was good enough to bring it up, risk assist, and what Josh is talking about with bonds. And you'll often hear the word drawdown during meetings, maybe not even mine if you listen to others. Drawdown is a replacement for the word loss, okay? And that's kind of a pet peeve of mine, but anyway. So the reason that risk assist, that I went out and found Horizon Investments, and I went out and found Beacon Capital Management, who you're all, many on the call are also familiar with. I moved away from the idea of if you're 70 years old, you should have 70% in bonds. I moved away from that in 2004 because coming off of the tech meltdown, one of my favorite sayings is that I only need to get hit in the head with a skunk once to know that it smells. That smelled bad. 70% off the NASDAQ. You thought we were supposed to be able to head to bonds and be able to be safe there. There was no safety that was available. So I went to look for, I'll say, a better mousetrap, and met different firms along the way. The one that stayed the longest, and you're hearing it on this call, is Horizon, because of their ability and willingness to do just as I've done over the years, which is to change their thinking and outlook on the portfolio construction. So we're getting into, I'll say, the weeds here, but I think it's important to bring it up since it's part of the conversation. We do, in my opinion, need to look at how do we grow portfolios. We should always be doing it. We should always be looking at how do we grow portfolios while taking an appropriate amount of risk for each client. So it's not specific advice as I read in the disclosure, but it is specific to Tranquilli Financial Advisor. There is a way that I want to do this for the people that I'm working with, and it includes that risk mitigation. It includes that ability to get away from the stock market, and it doesn't necessarily mean that we're doing so by owning bonds as a version of the safety. So it's really good for everyone here to get a reinforcement of that conversation. So I appreciate you bringing it up, Austin.
And Lou, let me just piggyback on that really quickly. The thing is that things change, and we're trying to measure change all the time and sort of adapt to it. And I think that Austin's having this conversation about, hey, as I get older, maybe I do need to continue to hold equities or marginally increase equities potentially in a distribution phase. But at the same time, he said we're still going to have volatility in equities. Do your own research, but it is kind of interesting to look at sort of the corrections that we've had the corrections themselves have been pretty much in line with what we would historically expect. It's the reversions that have been different than they have been in the past. And so we're kind of trying to understand that and adapt because of it, but it still makes equities attractive because we do have these corrections that get sort of followed by reversions, and that's important too, which we didn't see, 30, 40 years ago, 50 years ago when we had these types of corrections. So,
and you prompt me to say this. This time isn't different. It's not. Okay, it's not different. However, the times are different. Okay, and that's how we have to approach this. We have to be willing to go out and seek a better mousetrap endlessly. We may not find one, but we can at least make adjustments to what we're currently doing. And I think that's the environment that we're in. The tone of the market speaks to the stock market right now, and that's how we have to approach this. So, with a few minutes left, Austin, I'd like for you to just share what you think are challenges. The easy challenge to the market, of course, and I'll say market meaning stock market. The easy challenge to identify COVID and variants of COVID creating a slowdown again in economic activity. I don't think it's so bold to predict that is likely to happen. It's happened in Europe. I mean, you've got England on lockdown at this point. They're all the way back to that. So other than COVID, because I think that's the obvious statement, if you would give us what could be some headwinds or challenges to the market over the next, we'll say the next 12 to 24 months.
Yep. No, I think you're absolutely right. The obvious one, right, being COVID. Outside of that, what we're watching for in 2021 specifically is inflation. Again, it's not in our baseline kind of base case scenario. And I would say this, if you look at inflationary numbers that are going to come out as we get into March and April, it's going to look like inflation's running hot. Like I'll say that today on January 22nd, that as we get into the inflation numbers that are going to come out in March and April, those headline numbers are going to look like inflation is running above kind of that targeted 2% number that the Federal Reserve is said to be targeting. I say that because the way that they measure inflation, and again, we may be getting a little bit into the weeds, but I think it's important. The way that they measure inflation is it's a year-over-year comparison. Well, everybody on this call, everybody listening can think about where were we as a country in March and April of 2020? Where are we as a country in March and April of 2021? What's the outlook? Again, as we talked earlier, what's the consumer doing? The year-over-year change, probably for the next 4, 5, 6 months, it's going to look really, really good, and that's going to make inflation look like it's running hot. But what we're looking probably more interested in is what does inflation look like as we get into October, November, December? What does it look like as you get in the latter half of the summer of 2021? Is it staying around, right? Is the year-over-year comparison from an inflationary perspective going to be something that's going to stick with us? A lot of the conversation comes from, do we think the money on the sidelines, the stimulus money, do we think that is going to push inflation higher than that 2% threshold? I would tell you, again, base case, we don't believe that. The reason we don't believe that is if you look at all the stimulus money that came in, that was, again, at the time unprecedented in 2008, 2009, I think it pushed us above that 2% number for like 4 months, 5 months when it started to flow through in 2010 and 2011. That's kind of our baseline or base case expectation for 2021, but we do know it's a possibility. So we're monitoring that very closely. Because if you start to get inflation, I guess the good news is the Federal Reserve feels like they at least have the tools to handle inflation. They can dampen inflation. I guess again, good news is that's something that they feel comfortable dealing with. If it was the other side of the equation, if we were worried about deflation, I guess in that scenario, we would actually feel like we were in more trouble. The reason I say that is that there's really no central bank that has ever proved that they have the tools to get out of a deflationary spiral. It tends to just work its way out over time, and then the economy is kind of left in shambles once it finally does. So luckily, we're not there. And again, we don't necessarily believe inflation is a 2021 problem from a big risk standpoint, but it's absolutely something that's on the radar. The other thing that we're monitoring, and we talked about this at the very beginning, is the political side of things. Again, we have no reason to believe, based on the current composition of kind of the House and the Senate, that you'll see those radical or progressive legislative ideas come to pass. And I say that talking about many of the topics that are brought up. But I do think there are things on the table that could be, I'd say, concerning or could cause the market to at least take a step back. Maybe a good example, I think it's probably fair to say that we're going to see taxes increase both corporately and personally. I would argue the market's already prepared for that to some extent. And we're not going to see massive hikes, at least from our opinion, in the near term. I think we probably see personal rates go back to where they were during the Obama administration. And again, that's something that realistically the market has already kind of priced in. On the corporate level, you're not really going to get tax hikes or tax rate increases as much as you're going to get tax incentives and tax cuts rolling off. So you're going to get taxes bumped back to where they were really the first year or so of even the Trump administration. So it's not going to be, we're not going to go from a 15% corporate tax rate to 25. We're probably going to go from 15, 16 to 18, 19. And again, that's more of a roll off of that incentive. But what we're watching from a risk standpoint, is there anything else tax wise? And specifically, let's talk about capital gains and dividend income. Do those start to get taxed as ordinary income? We believe that if that were brought forth and that gained traction to where even some of those more conservative Democrats, or for that matter, even more of a left-leaning Republican could get behind that, if that's the case, we think that could be a headwind. And I mean, Lou, I would tell you from an industry perspective, I think that could be challenging for our industry, but also from a market perspective, I think that could be a headwind where it would in some cases disincentivize kind of the investing side of things, which again then puts pressure from a market perspective. Again, we don't believe that to be base case. We don't see that as something that's coming sooner rather than later, but it is something that we're obviously aware of and keeping an eye on. Should that come to the forefront later this year or early next.
All right. And if I always want to clarify, when you say left, right, radical, anything else, it's politics as it applies to investing, okay? Not politics
100%.
as it applies to, we did jokingly say before this meeting that we'd talk politics, religion, and drinking during the whole thing. So, but we're not going to do that, all right? So politics as it applies to investing money. All right, so a couple of things. First, of course, thank you, Austin, again for the insight. It is always appreciated. Josh, always appreciate you setting these up. I know the clients that are here live, I get messages later on from many people thanking me for putting them together. So it's great insight. We have a couple of things. I just want to point out that next Wednesday at 11 a.m. I will have Morningstar Investments. We'll be having another video conference with Morningstar. They are a very different, I'll say, manager from Horizon Investments, and again, the theories working on client portfolios different. So next Wednesday, 11 a.m. Eastern time, I'll host Morningstar. Josh's daughter is turning 18 today. Now, you may remember her from a previous video conference. She just came buzzing right through the video conference within the piano room. And Josh's camera immediately went off, and a few minutes later he came back. So happy birthday to her. And Josh, as I've told my children as they've turned 18, you may want to use this one. You are now legal, so don't do stupid things because mommy and daddy cannot get you out of trouble anymore. So, so you may want to share that one with her. And last but not least, behind me, and I'll just reach over here and bring a few of them. Actually, I should point out the basket too. That came from the Red Mill here in Clinton. If you're not familiar with the Red Mill Museum and Village, they are, it's a great organization here. The Red Mill is historic in Clinton. It's actually the most painted building in the state of New Jersey. I don't know where that statistic comes from, but it's been repeated over and over, and I don't doubt it. It's I believe it, I guess is the way to put it. So
one of my favorite views from that bridge.
It's awesome. There's no other way to put it. So and then I just sent out an email introducing our intern for this semester, Greg Taylor. He couldn't join us today because he's doing what students do. He's in class, and I, as much as I would love for him to be here, he'll join us at a later date. But I did include some books in my email, or the mention of books that I asked them to read from time to time. So I had a couple of them. I would share The Greatest Salesman in the World. It has nothing to do with being a salesman. Manifest Your Destiny, Wayne Dyer. Outstanding one I read a long time ago. The One Thing and The E-Myth. Those are all books, part of the books that I have the students read that are part of my intern program. So I just thought I'd share those to end our conference call today. Thank you both again. Thanks everybody for being here, and I look forward to seeing you again next Wednesday at 11 a.m.
Thanks, Lou.
Thanks, Lou.
Enjoy.
Everybody have a great weekend.
All right, we'll do.